Guys, there is a project called Usual that's really been stirring up a lot of buzz in crypto. It is a protocol where it allows you to own the actual stablecoin and you get to take part in the distribution and the yield that it makes, unlike USDC, unlike Tether, where once you buy USDC on Coinbase, it takes your dollar, issues you USDC, but it takes your dollar and it uses it to invest in treasury bonds, gold, commercial paper, a little bit of Bitcoin. We made a video on why stablecoins are crypto's killer app. Definitely give that video a watch if you haven't. But this protocol Usual is trying to flip that on its head. So in this video, I'm going to be delving deep into what Usual is, what makes it different. We're going to read through all their docs. We're going to look through their website. And if you stick around till the end, I'm going to tell you if I'm buying it or not and why. And my answer may surprise you. So before we get into it, I do have to say none of this is financial advice. These are my own perspectives, research, and opinions, and should be treated as such. So without further ado, let's jump straight into Usual, per usual, by starting with the docs. Okay, so here we are on the docs here. So it says it's time to choose a new solution. As a user or investor, have you ever dreamt of owning a slice of the $120 billion Tether company? Usual makes that a reality. It's a safe, transparent, and decentralized Tether. Usual redistributes not only the yield, but the ownership on the infrastructure. So it says Usual is a secure and decentralized fiat stablecoin issuer that redistributes ownership and governance through the Usual token. It says Usual is a multi-chain infrastructure that aggregates the growing tokenized RWA from entities like BlackRock, Ondo, and Mountain Protocol, MO or hash note to transform them into permissionless, on-chain verifiable, and composable stablecoin, USDO. Usual is built around the redistribution of power and ownership to users and third parties, akin to a scenario where Tether's TVL providers would own the company and the associated revenues. And if you guys didn't know, in the entire world, Tether has the highest revenue per employee. They have like 30-something employees, but they make billions of dollars. It's crazy. So why Usual? It says here, Tether and Circle generated over $10 billion in revenue in 2023, with valuations exceeding $200 billion. None of this generated wealth is shared with the users who contribute to their success. And number two, RWAs are growing, but their integration into DeFi remains challenging despite the arrival of on-chain treasury bills. This is evident from the fact that there are fewer than 5,000 holders of real-world assets on the mainnet. Number three, DeFi users desire exposure to the success of projects they support. The current yield distribution model fails to adequately incentivize users who take on greater risk by joining early and contributing to the project's success. Usual give both yield and growth exposure. So it talks about how Usual is introducing a model that aims to rebuild Tether fully on chain. And in the system, the issuer is controlled by the holders of the Usual governance token. This includes decision-making over risk policies, the nature of the collateral, and liquidity incentive strategies. And they're saying since they're leveraging blockchain technology, Usual ensures that control is decentralized, which allows for solid and resilient neutrality. Number two, fiat stablecoin needs to be bankruptcy remote. So it says fiat-backed stablecoins are partly collateralized by reserves held in commercial banks. This exposes them to fractional reserve practices of these banks, compromising the security and stability of the stablecoin. The recent collapse of Silicon Valley Bank highlighted the systemic risks commercial banks pose to DeFi due to their under-collateralization. And it talks about how USDO is 100% backed by real-world assets and how fiat-backed stablecoins have 10% plus in bank deposits, and then US Bank is 10% backed in deposits, okay? And it says here, the whole point of a stablecoin is to ensure that the value remains stable relative to the currency it represents. Users must have unwavering confidence that their capital is secure. Usual offers a collateralization model that is not only tied to the traditional banking system, but directly to very short-term bonds. The security provided by this prudent approach is reinforced by strict risk policy and an insurance fund. And it shows this graph here, and it says it's designed around the concept of redistributing infrastructure ownership to the total value lock providers. And it's similar to the scenario where Tether's TVL providers would own the infrastructure and receive the related revenues, which would be a lot of money because Tether literally is a money printer. So they distribute all the yield and the money that the protocol makes through the Usual token. So it talks about how it works here. So it says Usual aggregates the yield generated by the collateral backing, which is short-term bonds. Bonds pay you passively, backing a stablecoin into the protocol's treasury. Rather than redistributing this yield directly as cash flow, the value is retained within the protocol, enhancing the intrinsic worth of the governance token Usual. This token grants users both ownership and decision-making power over the protocol, its treasuries, and future revenues, aligning incentives and fostering sustainable growth. So it goes through the ownership and revenue sharing. So the treasury allocation, 100% of the protocol's revenue flow into the treasury, and 90% of the ownership of these revenues distributed to the community via governance token, right? Actual cash flow reflecting real-time protocol revenues in the treasury. Future cash flow, it talks about the governance rights, utility rights, and it says this model not only redistributes revenue, but also ownership, creating powerful incentives for early adopters. By aligning these interests among participants through transparent public token distribution, Usual establishes a robust foundation for sustainable growth and decentralized governance. So this shows the Usual model here, right? So you deposit USDO, which is a fiat stablecoin, you stake it, right? And you earn yield in Usual. When you stake it, you get the liquid staking token USDO, and then you earn Usual. And it shows the equivalent for TradFi. So this one is a deposit account. This one's a savings, the utility, payment, trading, collateral, right? This is like a currency. This is savings. So it's just savings and yield. And it shows how it accrues value. It shows the upside, right? And I'll leave it to you guys to go through and read all that. I feel like this video is already getting pretty long. And then it says Usual is centered around 3 core products: the stablecoin designed for payments, right? The liquid staking token, which is a yield generating product like a savings account, and the governance token, which pays out the revenue from these 2 items up here, right? And it shows this as a graph, and it shows the flow down here. So it's USDC is swapped against USDO and can be staked to earn USDO plus, allowing users to eventually earn ownership in the protocol's token Usual, which is used for governance. The infrastructure layer, it says here, is a multi-collateral aggregator that gathers liquidity and invests in on-chain T-bills from the user's USDC, with 100% of the revenue going to the protocol's treasury, which is managed by Usual holders. And it says for the distribution model, Usual is issued in a deflationary manner, with 90% of the protocol revenue supporting operations, stakers, and liquidity providers, while 10% is distributed to Usual holders. All right, so this is their first product, the stablecoin, right? And it says it's the first liquid deposit token offered by the Usual protocol, representing a significant advancement in stablecoin technology. It's backed 1-to-1 by realworldassets. Now, it's like when they say this, all stablecoins are technically backed by real world assets, right? Commercial paper is a real world asset. It's an asset in the real world. So is everything else that they're holding. So I don't know if they're categorizing it into some other subcategory in RWA, but I get, they're trying to stand out here. And it says they're the first RWA stablecoin that aggregates various US Treasury bill tokens, providing a sheer bankruptcy remote solution unlinked to traditional bank deposits. I just don't know how much yield they're going to be able to offer to the Usual holders if they're just investing in these short-term treasuries. Now, short-term treasuries pay out more than long-term treasuries, but with interest rates dropping, I'm just wondering how lucrative they really are. And it talks about the key benefits: permissionless, composable, transparency and trust, enhanced security, unified liquidity. The important thing is, can I use this as collateral to take out a loan? Does it work with other DeFi protocols where I can go and use my USDC and my USDT, right? How does it plug into other apps is the important thing. So they talk about how they have transparent and rigorous prudential policies, ensuring stability with short maturity assets, right? So I guess their thought process is they're able to, liquidate these quicker, right? With less price fluctuations, it sounds like. And then let's talk about the USDO collateral. Right, so they talk about they have a partnership with Hashnote, which is USYC, which is the on-chain representation of the Hashnote International Short Duration Yield Fund. Okay, and they primarily invest in reverse repo and U.S. government-backed securities. And it says being invested in an overnight repo means minimize market risk, duration risk, and credit risk is as good as being in a U.S. Treasury money market fund, but with the transaction speed, transparency, and composability of being an ERC20 token. So it lets you earn risk-free returns. Assets are deployed in reverse repo, with some allocated to T-bills to ensure maximum liquidity and minimum duration risk. So the more risk-averse you are, and you're just getting yield from these T-bills, your yield's not going to be that much, right? It's not even probably going to be over 10%, right? So it's I'd rather take my USDC and go put it in a liquidity pool, pair it with ETH, and get almost triple digit yields or more versus, I can own this stable coin and get 10%. I don't know, that's how I look at it. But it is a very interesting project. Let's look at this liquid staking token here. And this is basically what you get once you stake. If it's like any other project, you can take it into DeFi and get a yield on it. So like double dip, right? And it says it's a staked version of USDO for 4 years, function as a liquid stake token with USDO as a principal. So yield distribution, it distributes yield in the form of coupons paid in daily usual. So once you stake your USDO and then you get this liquid staking token and you hold it, right? It sounds like you get paid the usual token. So that's 3 different things, which is a daisy chain. And it sounds like if one of them goes to shit, the other ones do too, but I could just be missing something. And it says it offers a minimum yield in USDO equivalent to at least the risk-free yield. Let's see what that is. So the current risk-free rate is around 4.1%, not too far from inflation, right? And it shows 1 year 4.1, 20 year 4.8, 1 month 4.2, 3 month 4.3. And it's just like, guys, we have our yield hunter tool here where it shows the top liquidity pools in all of DeFi, and you can see its yields in the thousands of percentages, right? A lot of them are meme coins, but like Brett wrapped ETH 910%. Even if I look at ETH USDC, which is like extremely low risk, right? ETH hasn't even hit all-time highs yet. 246, like you get triple digit yields on ETH USDC and pairing it with USDC. And yeah, USDC isn't paying you from the money that they make, but given that it can plug into all these exchanges, like look at the yields you can get it on it and ETH. Like shit, if you really want to get the risk-free rate, get into an ETH USDC pool, take the rewards, use it to buy the USDO token from Usual, and get your 4%. Okay? Now, if you guys want to get access to this tool in a community where we have a whole course that shows you how to use this tool and how to yield farm like a professional market maker. The course is 13 hours. We have a pretty vibrant community. We do calls, once every 2 weeks or so. We're going to start doing it more. Click the link in the description, book a free strategy session. You'll talk to me, and we'll see if our program is a good fit for you. I digress. Let's get you back to our usual scheduled programming. Sorry, guys. I got a lot of usual jokes. And now if we go to the governance token, it says that it gives you access to both yield and growth. It rewards the growth and adoption of USDO, align an incentive with users who can help expand the protocol's ecosystem. So it says this usual token represents ownership of 100% of the protocol's revenue. It's a governance token backed by real cash flows. It's a uniquely designed long-term value token. I mean, what happens if people just sell the shit out of it, right? What's this value then? Is my question. And as the protocol grows, Usual becomes increasingly scarce. The emission rate of Usual is relative to total TVL decreases with new deposits, which is intended to boost its intrinsic value. So it sounds like the more popular it becomes, they're burning it, is what it sounds like. But if we go to here, it looks like there's still some Usual to come onto the market because the market cap's smaller than the FDV. It talks about the problem with most governance tokens, merely copy-paste replicas, trying to find the balance between short-term farmers and long-term buyers. Selling pressure is really offset by long-term demand. Poor correlation between value and governance. Too many tokens are issued by the protocol with the primary goal of enriching the users without creating a tangible connection between the token's value, its revenue potential, and real utility, and the misalignment of interest. So let's see, how are they doing it different and why is it valuable? So no VC dominance, so they didn't raise any VC capital. Okay. Emission is linked to cash flow. So it says the issuance of Usual is directly correlated to future cash flows generated primarily by the stablecoin's collateral. The token supply increases in line with protocol's revenue growth, which is driven by collateral staked by USD holders, and focus on long-term ownerships. So it says, unlike many models where new entrants dilute the value and supply of governance tokens, pushing early adopters to sell quickly, Usual protects its long-term community. The model is designed to incentivize long-term holders, preserving value for those who believe in the protocol's future. So it talks about decreasing issuance over time. So the highest distribution rate occurs during the initial airdrop, decreasing over time as staked TVL increases. Okay, kind of like Bitcoin. Usual's emission model is designed to be disinflationary, much like Bitcoin. I promise I didn't plan that. I researched this protocol like 2 weeks ago, so I kind of forgot, and I'm just not getting around to shooting the video. So that's why it may seem like I'm just reading this for the first time. I've read like 20 other projects since then, so shit starts to mesh. And it says the inflation rate is calibrated to remain below the revenue's growth of the protocol, ensuring that the token issuance does not outpace the protocol's economic expansion. Okay, let's look at the tokenomics here. So I guess the tokens that are the discrepancy between the market cap and the TVL and the FTV is that, the more the protocol grows, the less they're going to mint out. So they still want to leave some out. And this shows the distribution model of the usual tokens. So it says the majority of usual tokens are distributed to users who actively contribute to the protocol's growth and value creation. Models designed to protect the community from any dilution caused by the team or investors, ensuring that incentives remain aligned with those who drive the protocol's success. So it says here, the DAO sets allocation percentages to various buckets that serves as distribution points for usual. The buckets are as follows. So 90% went to the community. It looks like 10% went to the investors and the team. Pretty unselfish of them, right? And it shows all of this here. And this basically shows the staking module. So you can stake the usual token without any mandatory lockup period. And it says the DAO retains the authority to impose an unstaking fee, applies as a percentage of the usual X being withdrawn. And this fee mechanism basically discourages short-term holding behavior while reallocating the collecting fees to reward and strengthen the alignment of incentives for long-term stakers. Let's check out some of their backers. So let's see if we can zoom in on this thing here. So these are their angels. So Axelar, it's a pretty big project. Let's see if there's anyone else here that I know. Nope, just a bunch of, seems like so you got Convex Angels from the Convex protocol, it looks like. And then you have Mantle. We did a video on Mantle, pretty big L2. Oh, Kraken Ventures, so that's good. And then we go through their smart contract audits. Looks like they had a few of them here, which is good. I like to see that. More than a few. Got a lot of them. So yeah, and these audits aren't cheap. They didn't raise VC capital. So one thing I can say about these founders is that it sounds like they really believe in the project. And I like to see that. I do like to see that. Now, if we go to their website here, it pretty much talks about all the stuff that we're talking about. Cool graphics on here. I like how this thing moves. You can swap for USDO, right? Shows their backers. The more you scroll down, the more this thing comes apart. That's pretty dope. I like that. And I want to do something like that for a NoDAO's website. That was pretty cool. And it shows some of the liquidity pools with some of the yield. So, okay, looks like you can pair the token with something. Pendle's been integrating with everyone. Still our largest holding here. 456%. It's not bad. That is not bad. And you get a bonus. So I bet most of it's in the bonus. Let me calm the fuck down. Got your FAQ questions. They got a bug bounty, so that's good. So they're incentivizing / paying people to find bugs in the code. So all in all, pretty solid project. They are giving it their all. I will say that. And if we hit access app, restricted region. Let me go back and try to turn on my VPN. So I got my VPN on. Let's try to access the app now. Looking good, looking good. So they have a TVL of 1.7 billion, 72 million in revenue, and 88,000 users. So yielding opportunities, usual X 255%, 30. So these are like stablecoin pools. It's just, you got to really trust the stablecoin. Even though it's backed by something, that doesn't mean it can't go to zilch because people aren't buying it. Like, that's the only part for me. Let's click on this one and see what this one's about. Okay, so this one is basically pairing the usual token. So it's almost like single side staking the usual token. If this depegs, then you're fucked. But yeah, same idea with pairing a stablecoin and a stablecoin. So if you believe in it and you want to get 255%, I say have at it. Just make sure you have on your VPN every time, because who knows what happens if you try to connect on here and then you're not connected. And then your funds get stuck because they realize like, oh, this motherfucker is using a VPN. So now we got to the end of the video. Am I buying this or not, and why? I am not. I understand the protocol, but it's like my brain is still like wrapping around it. Like, I get that the usual token is backed by real world assets, but you got to be careful with stable coins, right? And it's 2 stable coins before you get to the usual protocol. And I see the problem that they're trying to solve, but it's just so much easier to get yield in other places. I'm not romantic about the idea of being able to own a piece of the stable coin. Like, if I could own a part of Tether and the revenue that they get, same with USDC, yeah, I would. And, who's not to say that they can't get that big, but it is a steep climb. It's a tall order, right? It's not going to be a walk in the park. But it is possible. But it's just other projects where I think I'll be able to get a better return. I understand the business model a little better. I know who the team is. So I'm just placing my chips where I'm most convicted, investing where I understand the most. So that's why I'm not buying it. But I do like the project. You know, I'd love for the team to reach out. Maybe we do an interview, get an understanding on some things here. So yeah, with that, I'd like to conclude this video. Guys, give me feedback. Let me know if I missed something, if I misinterpreted something, if you had a question on something. Let me know what other projects you want me to cover, whether it's stablecoins, RWAs, AI. We're really trying to focus on AI projects right now. But with that, like, comment, subscribe, share with a friend. I thank you guys so much for tuning in. I love every single one of you who's watching right now. And I will see you in the next video. Take care and trade safe.